Being a trader in the cryptocurrency space can be fun, educational, and of course profitable, but it all depends on which markets work for you. What's going on, guys? Ryan Martello here. Today we are going to be diving into the differences between spot markets and future markets coming up. Today's video is brought to you by BTSE.com, a safe, reliable, and global multi-currency digital asset exchange and derivatives platform, offering up to 100x leverage and of course fiat support. If you would like to learn more, don't be afraid to hit that first link in the description. First, let's discuss what both markets actually are and how they operate. What is a cryptocurrency spot market? The process of buying or selling a cryptocurrency and having the exchange settle immediately. For example, if I was in a Bitcoin spot market, I would be able to buy or sell Bitcoin immediately and have direct control over my Bitcoin. From there on, I could send it to my own wallet, or I could keep it on the exchange for future trades to come. A futures market is where participants buy and sell contracts for delivery on a specified date in the future. They are typically used by traders as a way to hedge other investments or to lock in profits when trading in volatile cryptocurrency markets. Financial instruments on the futures markets are also known as derivatives because the pricing of the contracts is based on the underlying security in the cash market. Now that you have a good understanding of spot and future trading markets, let's look at some key differences. Counterparty is the process where there is a buyer and a seller for each transaction. Since future trades settle in the future, the last thing you want is to have no one on the other side of the trade. Future exchanges utilize two risk mitigation techniques to prevent this from happening. First, we have performance bonds. To begin placing trades, you need a performance bond or initial margin. This essentially is the crypto in your account to cover trade obligations. Secondly, we have maintenance margin. The maintenance requirements is the minimum amount of crypto needed to cover all open positions. Now, when it comes to the counterparty risk and spot market trading, margin in the spot market is an upfront fee with the broker and is not related to counterparty risk. Now, in the futures market, the underlying asset has a specific settlement date in the future. If you are a long in a futures contract, you agree to buy that contract on a specific date down the road. Conversely, if you are short, you have entered an agreement to sell the contract on a future date. Now, this is where traders in the futures market really come up ahead. When it comes to hedging against the risk, traders in the future market can really take this to their advantage by hedging against spot market traders. Why not the other way around? Well, your ability to leverage is far greater in the future markets. Therefore, you can purchase a few contracts, but able to hedge against a sizable spot market position. The spot market is going to be best for the traders that don't want to have to worry about time and they want to be able to buy and sell cryptocurrencies instantly and of course have access to those currencies instantly. Now, the futures market is going to be for the traders that really want to hedge against the overall cryptocurrency market. And of course, this can make you a reasonable return if you can predict the market correctly. Now, the spot market and the futures market have their pros and cons, but make sure whatever market you choose, it best suits you as a trader because in the end, it is your money you are messing around with. Now, I hope you guys found this video informative. If you have any questions at all, don't be afraid to leave a comment down below. And of course, if you did find this video informative, I would greatly appreciate it if you would give this video a thumbs up. Thank you all so much for watching, and I will catch you in the next.